Capital and revenue expenditures. Capital expenditures. When an organization purchases permanent assets or fixed assets or improves their life, it is known capital expenditures. It is based on long term. It helps to increase production volume or decrease cost of the production. It means when we purchase the fixed assets, it helps to increase the production volume and decrease the cost of production. It is non-recurring in nature. It means it is not repeated. Capital expenditures are shown in asset side of balance sheet. It means capital expenditures are shown in asset side of balance sheet. Some capital expenditures are purchase of fixed assets like land and building, plant and machinery, furniture and equipment, transport. Here transportation. Transport means here transportation, installation and erection charge of fixed assets, legal charge and registration charge for purchasing fixed assets. It contains insurance, road tax for vehicle, etc. Expenses paid to improve extending working capacity of existing assets. It means when you purchase the second-hand vehicle, if you spend some amount to it running on condition, that is the extending working capacity. Underwriting commission and brokerage charge to issue shares and debenture, etc. These are the some capital. Now go for revenue expenditures. When an organization incurs expenses for operation activity of the business, it is known revenue expenditures. It is based on short term. It helps to operate administrative work. It is recurring in nature. And revenue expenditure may be daily, weekly, monthly or yearly. Revenue expenditures are shown in debit side of trading account or profit and loss account. Some revenue expenditures are purchase of raw material for manufacturing company, purchase of finished goods for resale or trading company, all purchasing expenses, all office and administrative expenses, all selling and distribution expenses, and all financial expenses, etc. Deferred revenue expenditures. Some revenue expenditures are incurred in advance for several years. It means on some revenue expenditures we invest lots of amount. That becomes a deferred revenue expenditure. These expenditure will provide benefit for the organization. Some deferred expenditure are pre-operation cost, preliminary expenses, heavy advertisement, cost of developing mines and plantation, etc. Above expenditures are written off during some years. These expenditures are treated as deferred expenditure. They are shown in asset side of balance sheet. Written off amount is deducted from deferred expenditure in balance sheet and debited to profit and loss account. For example, preliminary expenses is written on asset side of the balance sheet and the write off the preliminary expenses is deducted from preliminary expenses and the deducted amount is transferred to debit side of profit and loss account. Differences between capital and revenue expenditures. Basis: capital expenditure, revenue expenditure. Nature: capital expenditure is non-recurring in nature. Revenue expenditure is recurring in nature. Purpose: it is incurred to purchase fixed assets or improve their life. Revenue expenditure is incurred to manage day-to-day business activity. Term. Capital expenditure is for long term, more than 1 year. Revenue expenditure is for short term, 1 year or less than 1 year. Earning. It helps to increase earning capacity of the business. Revenue expenditure help to maintain earning capacity of the business. So, it is shown in asset side of balance sheet. Revenue expenditure is shown in debit side of trading account and profit and loss account. Thank you for investing your time. If you liked the video, turn black like button into blue. Suggest me on comment box. Subscribe my channel and help me. Thank you.